On January 1st, 2026, a financial tripwire is set to go off for millions of American families. This isn't some far-off theory. It's a scheduled event that could quietly pull thousands of dollars out of your pocket. A massive set of tax laws that have shaped our finances for years are simply vanishing overnight. For many, this will trigger the single biggest tax hike they've ever seen. But what if I told you there's a window, a rapidly closing window before the end of 2025, to make a series of powerful financial moves? Moves that can shield your family's wealth, slash your future tax bills, and turn this potential crisis into an incredible opportunity. The clock is ticking, and the steps you take in the next few months will define your financial reality for the next decade. In this video, I'm breaking down the exact financial moves you absolutely cannot afford to miss. We will go through step by step the strategies you need to deploy right now to protect your wealth and secure your future. This is not a drill. What you don't know about the great tax law sunset of 2026 could cost you dearly. All right, let's get straight to the heart of the matter. What is this financial earthquake I'm talking about? It's the scheduled expiration of the individual provisions of the Tax Cuts and Jobs Act of 2017, or TCJA. Many people don't realize this, but while the corporate tax cuts in that law were made permanent, almost all the changes for individuals and families were written with a specific expiration date. December 31st, 2025. Think of it like a long-term subscription that's about to end. Unless Congress steps in to pass new legislation, the U.S. tax code will automatically revert to the old, pre-2017 system on January 1st, 2026. And let me be clear, that old system means higher tax rates and fewer deductions for most people. This isn't speculation, it's the current law of the land. The default setting is a tax increase for a majority of taxpayers. So, what exactly is on the chopping block? It's a massive list, but here are the heavy hitters that will impact your wallet the most. First, individual income tax rates are going up. The 7 tax brackets we have today, 10%, 12%, 22%, 24%, 32%, 35%, and 37% will be replaced. The brackets are set to revert to 10%, 15%, 25%, 28%, 33%, 35%, and a top rate of 39.6%. Notice that several of those middle income brackets are jumping significantly. The 12% bracket goes to 15%, and the 22% bracket goes to 25%. For a family in that 22% bracket today, that's a direct hit. Second, the standard deduction is getting cut nearly in half. The TCJA almost doubled the standard deduction, which led to about 90% of filers taking it instead of itemizing. That higher deduction vanishes in 2026. Projections show the standard deduction for a married couple filing jointly could plummet from its current level to around $16,700. For a single filer, it could drop to about $8,350. This means millions more people will suddenly find themselves needing to itemize deductions again. And many will see their taxable income shoot up even if their salary doesn't change. Along with this, the personal exemption, which was eliminated by the TCJA, is set to return. Third, the child tax credit is being slashed. Under current law, the credit of $2,000 per child is scheduled to revert back to just $1,000 per child. Furthermore, the income phase-outs will become much stricter, falling from $400,000 for a married couple to just $110,000. This is a direct financial blow to working families. The smaller $500 credit for other dependents is also set to be completely eliminated. Fourth, for those in high-tax states, the controversial $10,000 cap on the state and local tax, or SALT, deduction is scheduled to expire. While recent legislation, the One Big Beautiful Bill Act, OBBBA, has increased the cap to $40,000 for 2026, this is subject to income limitations and is not a full repeal. And finally, the fifth and perhaps most dramatic change is the estate tax exemption. This is the amount of money you can leave to your heirs without paying federal estate tax. The TCJA doubled this exemption, but new legislation will set it at $15 million per person for 2026. While this is an increase from the 2025 level of $13.99 million, it solidifies the need for strategic planning. For families with businesses, farms, or significant savings, this is a monumental shift that could trigger a 40% tax on assets they thought were protected. So, to recap the problem, tax rates are going up, the standard deduction is getting slashed, the child tax credit is being cut, and the estate tax landscape is shifting. This is the financial reality we are heading into. The good news? Now that you know the problem, we can focus on the solutions. And there are powerful moves you can make before the end of 2025 to put yourself in the strongest possible position. Let's get into the game plan. Our first and arguably one of the most powerful moves to consider is a Roth conversion before the end of 2025. Financial advisors across the country are talking about this with their clients right now. And for a very simple reason. It's a massive tax arbitrage opportunity. So, what is a Roth conversion? Simply put, you're taking money from a traditional pre-tax retirement account, like a traditional IRA or an old 401k, and moving it into a Roth IRA. When you do this, you have to pay income tax on the amount you convert in the year you make the conversion. Now, you might be thinking, why on earth would I want to volunteer to pay taxes? The logic is simple. Tax rates are scheduled to be lower in 2025 than they are expected to be in 2026 and beyond. By converting in 2025, you're choosing to pay taxes on that retirement money at today's known lower rates, like 12%, 22%, or 24%, instead of the higher rates of the future, like 15%, 25%, or even higher. You're essentially locking in a tax discount on your retirement savings. Let's walk through an example. Imagine you're a married couple in the 22% tax bracket in 2025. You have $100,000 in a rollover IRA. If you convert that $100,000 to a Roth IRA in 2025, you'll add $100,000 to your taxable income and pay roughly $22,000 in taxes. Now, let's say you wait. In 2026, the tax brackets revert, and your income now puts you in the new 25% bracket. If you convert that same $100,000 then, your tax bill on the conversion would be $25,000. By acting in 2025, you would have saved $3,000. Now, scale that up for larger balances or for people in higher tax brackets, and the savings can be tens of thousands of dollars. But the benefit goes far beyond just tax rate arbitrage. Once the money is in a Roth IRA, it grows 100% tax-free forever. When you pull it out in retirement, every single penny, both your original conversion and all the decades of growth, is yours to keep with zero taxes due. This is incredibly powerful. Tax-free income in retirement is the gold standard, as it protects you from future tax rate hikes and gives you ultimate flexibility. Another huge benefit of Roth IRAs is that they are not subject to required minimum distributions, or RMDs. Traditional IRAs and 401ks force you to start taking money out and paying taxes on it once you reach a certain age. With a Roth IRA, you are in complete control. You never have to touch the money if you don't want to. This allows it to continue growing tax-free and makes it one of the most powerful wealth transfer tools to leave to your heirs. So, who should be thinking about this? First, if you believe your tax rate will be higher in retirement than it is today, a Roth conversion is almost always a smart move. This is common for younger professionals still early in their careers. Second, even if you think your tax rate will be the same or lower in retirement, you should run the numbers for a 2025 conversion. The unique situation of the TCJA sunset means 2025 offers a temporary sale on taxes. You might be able to convert a substantial amount at the 12% or 22% rate, which is a fantastic long-term deal. Third, if you have a large traditional IRA balance and are worried about future RMDs pushing you into a higher tax bracket in your 70s and 80s, converting some of that money now can reduce your future RMD liability and your overall lifetime tax bill. Now, a couple of critical things to keep in mind. A conversion is an irrevocable event. You can't undo it. The biggest factor is that you need to have cash on hand outside of your retirement account to pay the taxes on the conversion. You should never use the retirement funds themselves to pay the tax bill, as that could be considered an early withdrawal and trigger penalties. You also don't have to convert your entire account at once. A common strategy is to do partial conversions. You might look at your current tax bracket and convert just enough to fill up that bracket without bumping yourself into the next higher one. For example, if you have $30,000 of room in the 22% bracket, you could convert $30,000 of your IRA to a Roth, paying tax on it at that 22% rate. This is a methodical way to move money into the tax-free bucket over time. The window for this move is now. The great Roth conversion rush is happening for a reason. By taking advantage of the lower 2025 tax rates, you can secure a lifetime of tax-free growth and withdrawals. Talk to a financial advisor or a tax professional. Run the numbers and see if this powerful strategy is the right move for you before the clock strikes midnight on December 31st, 2025. The second major move you need to consider is a classic tax planning strategy that becomes incredibly powerful in a rising tax rate environment: accelerating income and deferring deductions. It might sound complicated, but the idea is actually pretty simple. You want to realize as much income as possible in 2025 while tax rates are low, and push as many deductions as possible into 2026 when they will be more valuable against higher tax rates. Let's break down the income side first. Accelerating income means getting paid money in 2025 that you might otherwise have received in 2026 or later. Why? Because you'd rather pay, for example, a 24% tax on that income now than a 28% or 33% tax on it next year. So, what are some practical ways to do this? If you're an employee with any control over your bonus, try to get it before the end of 2025. If you're a consultant or small business owner, you have much more control. You can strategically invoice clients and collect payments before December 31st, 2025 to ensure that income is recognized in the lower tax year. A huge one for investors is realizing capital gains. If you have stocks, mutual funds, or other investments that have appreciated significantly, selling them in 2025 locks in that gain at the current known capital gains rates. You can even sell the asset and buy it right back if you still want to own it. This is known as tax gain harvesting. The wash sale rule, which prevents you from taking a loss and buying the same security back within 30 days, does not apply to gains. Another area is stock options. If you have incentive stock options, ISOs, or non-qualified stock options, NSOs, exercising them in 2025 could be a smart move to recognize the income at lower rates. This is complex, so it's essential to model this out with a financial advisor, but the principle remains: realize income in the lower tax year. Now let's flip the coin and talk about deferring deductions. A deduction is always more valuable when your tax rate is higher. A $1,000 deduction in the 25% bracket saves you $250. That same deduction in the 33% bracket saves you $330. You want to time your deductible expenses for the year when they give you the biggest bang for your buck, which will likely be 2026. One of the biggest opportunities here is charitable giving. If you're philanthropic, consider making your 2025 gifts as usual, but bunch your planned 2026 contributions by making them in January of 2026 instead of December of 2025. For larger gifts, a donor-advised fund can be a great tool. You could make a large contribution to the fund in 2026 to get a big deduction in that year. Then grant the money out to your favorite charities over the next several years. Another key area is state and local taxes. A common strategy is to delay your fourth quarter estimated state income tax payment. Instead of paying it in December 2025, ensure you pay it in January 2026. This shifts that deduction into a year where it could be more valuable. Medical expenses are another area to watch. To deduct medical expenses, they must exceed 7.5% of your adjusted gross income, AGI. With the standard deduction getting smaller in 2026, more people will be itemizing, and this deduction will become relevant again. If you have elective medical or dental procedures you've been putting off, scheduling them for 2026 could help you clear that AGI threshold and get a more valuable deduction. The overarching strategy is to be deliberate. Look at every major source of income and every potential deduction and ask the question, can I legally and practically shift this into 2025 or 2026 to my advantage? This requires proactive planning, not just reacting in April. This level of planning can save you thousands simply by controlling the timing of your finances. The third critical move is to supercharge your retirement savings in 2025 and prepare for a new rule that kicks in for high earners in 2026. Maximizing your contributions to accounts like 401ks and IRAs is always a good idea, but it's essential in a year before tax rates are scheduled to rise. Every dollar you contribute to a traditional 401k or a deductible traditional IRA reduces your taxable income for the year. For 2026, contribution limits are projected to increase due to inflation. For 401ks, the limit is expected to rise to $24,500. The limit for IRA contributions is projected to increase to $7,500. The 401k catch-up contribution for those age 50 and over is also expected to increase to $8,000. You should aim to max out these contributions if at all possible. But here is where it gets really interesting. A new rule from the Secure 2.0 Act takes effect on January 1st, 2026, and it specifically targets high-income savers. If you are age 50 or older and your prior year FICA wages were more than $145,000, this number is indexed to inflation, this rule is for you. Starting in 2026, any catch-up contributions you make to your employer's retirement plan must be made on a Roth basis. Let's break that down. Currently, if you're over 50, you can make your entire 401k contribution, including the catch-up portion, on a pre-tax basis. This gives you the maximum possible tax deduction in the current year. For example, in 2025, a high earner over 50 can contribute their regular amount plus a $7,500 catch-up, all of which reduces their taxable income. Starting in 2026, that changes. That same high earner will still be able to contribute the regular limit, projected at $24,500 on a pre-tax basis. But if they want to add the projected $8,000 catch-up contribution, their company's payroll system will be required to direct that $8,000 into a Roth 401k. This means they will pay taxes on that $8,000 now, but it will grow tax-free for retirement. This is a massive shift in tax strategy. For years, the standard advice for high-income earners was to take the pre-tax deduction now. This new rule forces a portion of their savings into the Roth bucket, whether they plan for it or not. What does this mean for you? First, if you are a high-income earner over 50, 2025 is your last chance to make a fully pre-tax catch-up contribution. If getting the biggest possible tax deduction is your primary goal for this year, you need to ensure you max out that catch-up. Second, this change has a big administrative component. If your employer's 401k plan allows catch-up contributions but doesn't currently have a Roth 401k option, they are in a bind. Starting in 2026, they can't legally accept catch-up contributions from their high-earning employees unless they add a Roth feature. You should be talking to your HR department now to understand their plan. Third, this forced Roth catch-up isn't necessarily a bad thing. It's essentially forcing you to build up a bucket of tax-free money, which creates valuable tax diversification. In retirement, you can pull from the Roth account without increasing your taxable income for the year, which can help you stay in a lower tax bracket and avoid higher Medicare premiums. So the action plan for this move is threefold. Maximize your pre-tax retirement contributions in 2025 to get the largest possible deduction while tax rates are lower. If you are a high-income earner over 50, be aware that 2025 is the last year to make a fully pre-tax catch-up contribution. Investigate your employer's 401k plan to confirm they are ready for the 2026 rule change. Of all the changes happening, this is the one that should have alarm bells ringing for anyone with a net worth in the multi-million-dollar range. The window to protect your legacy from a massive and avoidable tax bill is shifting. As mentioned earlier, the federal estate tax exemption is the amount you can pass on to your heirs tax-free. For 2026, new legislation has set this exemption at $15 million per person. This is up from $13.99 million in 2025, providing a significant permanent shield for wealth transfer. A married couple will be able to pass on $30 million tax-free starting in 2026. Any assets above that amount could be subject to a federal estate tax of up to 40%. Let's put this in concrete terms. A married couple with a combined estate of $15 million in 2025 would owe zero federal estate tax. Under the new 2026 law, a couple with a $32 million estate would find themselves $2 million over the new limit. That $2 million surplus could be subject to a 40% tax. That's an $800,000 tax bill. The crucial thing to understand is that gifting remains a primary strategy. You have an opportunity to permanently move significant wealth out of your taxable estate. So what is the move? The primary strategy is strategic gifting. You need to consider making large gifts to your children, grandchildren, or other heirs to take advantage of the high exemption amounts. The simplest form of this is using the annual gift tax exclusion. You can give a certain amount per year to as many individuals as you want without it eating into your lifetime exemption. But the real power lies in using that large lifetime exemption. For those with significant wealth, more powerful strategies involve advanced trusts. These are legal structures that move assets out of your estate. One popular tool is a spousal lifetime access trust, or SLAT. You create an irrevocable trust for your spouse and gift assets into it, using a portion of your lifetime exemption. The assets are now outside of your taxable estate. The brilliant part is that while you can't access the funds, your spouse can receive distributions, providing an indirect safety net for your family while protecting the assets from estate taxes. Another powerful tool is the Grantor Retained Annuity Trust, or GRAT. With a GRAT, you transfer assets into a trust that pays you an annuity for a set number of years. If the assets in a trust grow faster than the IRS mandated interest rate, all of that excess growth passes to your beneficiaries completely free of gift and estate tax. The key takeaway is that these strategies are not do-it-yourself projects. They require a team of experts, an estate planning attorney, a CPA, and a financial advisor. This process takes time. Drafting trusts and retitling assets can take months. You can't wait until the last minute. The rush is already on. If your net worth is anywhere in the multi-million-dollar range, you are facing a flashing red light. Doing nothing is a choice that could cost your family a fortune. Seize the opportunity presented by the high 2025 and 2026 exemptions. Schedule the meetings, explore the strategies, and make the plan. This is a critical move for wealth preservation. The financial landscape is clearly shifting, and staying ahead of these changes is absolutely critical. If you want to make sure you're always up to date with the latest strategies on how to protect your money, grow your wealth, and navigate these complex tax laws, make sure you subscribe to this channel and click the notification bell. We are constantly breaking down these developments to give you clear, actionable advice. If you have any questions about the TCJA sunset or the moves we've discussed, drop them in the comments below. We've covered a tremendous amount of ground, and it's easy to feel overwhelmed. but paralysis is not an option. The financial rules are set to fundamentally change on January 1st, 2026, and proactive planning is your only defense. Let's quickly recap the critical moves to consider before the end of 2025. First, explore a Roth conversion. With tax rates scheduled to increase, 2025 offers a temporary discount for moving money into a tax-free Roth account. Second, master the art of timing. Accelerate your income into 2025 to pay taxes at lower rates and defer your deductions into 2026, where they will be more valuable. Third, supercharge your retirement accounts. Maximize your contributions in 2025 and understand the new Secure 2.0 rule that will force high earners to make Roth catch-up contributions starting in 2026. And finally, address your estate plan. The estate tax exemption is changing. You must act now to use strategies like gifting and trusts to lock in current high exemptions and protect your legacy. The theme that runs through all these strategies is foresight. The financial landscape of 2026 and beyond will be divided into two groups of people: those who were caught by surprise by the TCJA sunset, and those who saw it coming and acted. The steps you take in the coming months will determine which group you fall into. Don't let these changes just happen to you. Take control of your financial destiny. Have the conversations with your spouse, your financial advisor, and your tax professional. Run the numbers. Make a plan. The clock is ticking, but there is still time to make the moves that will secure your financial future for years to come.